Good evening, everyone. Welcome to our Sac State Alumni and Athletics Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone this evening. This is our first meeting together for 2024. We've got a chance to host this quite a few times, actually 4 times in 2023. So this is our first class for 2024. Great to see everyone. I appreciate you taking time out of your busy schedules to join us to talk a little bit about home buying. I know we have quite a few that have signed up for tonight's class. So we're going to allow everybody to kind of file into the Zoom room, and we'll get started in just a few minutes. Just a reminder, or just to let you know, our class is going to be recorded today. All of our material that I share with you this evening will be up on our YouTube channel tomorrow. We're also going to go ahead and broadcast out the presentation to you as well. We'd encourage you to take some great notes because that improves retention of all these kind of terms and so, as you're kind of going through tonight's class, just know that we'll have all this information out to you tomorrow. So now we also encourage questions in tonight's class. So we try to make this a very interactive session. So as I go through tonight's content, you have a question, just drop it in the Q&A, and then we'll get a chance to answer those questions on air. Now, we're doing something a little bit new this year, which is just getting a sense of like, where is our class joining us from? So we teach classes now across the entire country. So I know most of you are probably based here in Northern California and Sacramento, but since Sac State alumni stretches fairly wide, we love to know where you're joining us from. So if you get a second, just drop in the chat where you're joining us from. And it's kind of interesting when we look at that, where you are joining us from, because if you're looking to purchase in that particular community, we're going to be talking about market data in respective areas across California. So it'd be interesting to see where you're joining us from. So thanks for doing that. Again, if you get a chance, just drop in the chat where you're joining us from. So Sacramento. Okay, a lot of Sac-town already, which I kind of expected, but I thought I would just ask the question. Vacaville, okay, all right. All right, very good. Okay, cool. All right, very good. All right, thanks guys for participating. We got San Jose in the Bay. Okay, good. So thanks again for participating in that little exercise to get us going. Just a little bit about me. Again, my name is Jason Maida, and so I'm with an organization called American Pacific Mortgage. So we're a leader in first-time homebuyer programs, and we have an educational platform where we basically teach classes across the country through partnerships like the Sac State alumni. I'm thrilled to get a chance to support the Sac State alumni and Stingers Up. It's a great organization that allows us to obviously help our local community, because most of you guys are in the Sacramento market, and so it allows us to be able to kind of serve right here in our own backyard. American Pacific Mortgage is actually based out of Roseville, California, so just 30 minutes up the road, but we are a nationwide lender. So we teach classes like this all across the country. You'll learn a little bit more about other partnerships we have, but we get a chance to do this basically about once or twice a week. So if you do like some of the content tonight, we'd encourage you to like share this information with friends, family, coworkers. Usually most of our classes are kind of open to anybody in the community. So we'd love for them to be able to check this out. Well, here's what our talking points are going to look like tonight. We're going to spend some time looking at the housing market. We're going to look at, home values. We're going to look at what interest rates are doing. We'll spend some time, which will be one of our first exercises, looking at like a budgeting exercise just to see kind of, what this would look like if we do consider home buying. We'll then look at credit. We'll spend some time looking at student loans, how those can impact qualifying, talk a little bit about loan programs that are offered to you as a first-time buyer. And then we'll look at documentation around income and assets that we'll generally need as we start this kind of journey towards home ownership. And then we'll spend some time looking at assistance programs. Since most of us, if not all of us, are in California, there's some exciting programs that are available to first-time buyer programs. I'm going to share with you one of those programs that you may have even heard about already in advance of tonight's session, which is called the Dream for All program offered by the California Housing Finance Agency. So we've been taking a lot of consultations with clients on that. If you're interested in that, you'll learn a little bit more about that tonight. And then finally, we will wrap up tonight's discussion, which will take us just about to the top of the hour, learning a little bit more about the buying process. So after tonight's class, if you're kind of excited about home ownership, and hopefully you are, we'll kind of give you what the path to home ownership looks like to be able to sit down with us and create a plan to help you on this journey. All right, so that'll get us started for tonight. We have a nice full class. I'm really excited that you guys could join us. So let's first of all talk a little bit about buying, what does that mean for us? So we think about home ownership, it's the American dream, so it's called, right? But I think we got to think about what's the benefits that come along with owning a home, because for some of us, it's not, maybe beneficial for us to purchase a home, right? There's trade-offs that we're going to have to make with owning a home. But I think at the same time, there's a lot of great benefits that come with that trade-off. So you create stability in your house payment, so you don't have to worry about your lease being increased every time you decide to renew your lease. This is an asset that will appreciate hopefully over time. Real estate cycles like anything, but over time that home should hopefully appreciate. As that home appreciates, equity is being created, right? So the difference in what a home is worth versus what you owe on the home, that difference is home equity. And there's still some great tax benefits that could still potentially come along with owning a home, with interest deductions that you could potentially take as a homeowner. So when we think about home ownership, we really want to factor a lot of those characteristics into a budget. And so the way we start most of our classes off is by looking at a budgeting tool. So we can take into consideration all the great things that come along with home ownership, but how does that stack up against what I'm doing currently as a renter? So let's take a look at this budgeting tool. And in case I know we had some of you join us later on in tonight's class, but all of our presentation material is going to be available for you tomorrow. The recorded version of tonight's class is going to be up on our YouTube channel as well. So you can check that out as kind of to be able to kind of review and check back on some of your notes. So let's walk through this calculator. This calculator is brought to us by Freddie Mac, and it's available to you online. It's basically allowing us to do a side-by-side comparison of renting versus buying. So, and we're going to basically timetable this at about 7 years. Okay. So we just put in, for timing purposes in tonight's discussion, we kind of already pre-filled everything for you, but let's assume that we're paying rent of about $2,000 a month in rent, which you can see over here. We have monthly renter's insurance of $20 a month. We have a rent increase. So we're projecting out, by taking rent versus buying over the next 7 years, we're projecting our rents to go up by about 5% every year. We have our home purchase being around $475. Now, I know these numbers vary for all of you in tonight's class. So some of you want to buy in certain parts of Sacramento. Some of you, like one of our guests, is in the Bay Area. Those prices are going to look a little bit different. So, it does vary for all of us here on tonight's class. But let's assume we have a $475 purchase price. The minimum down payment is 3%. You're going to learn a little bit more about that in just a bit. And under our loan program section, we factor in property taxes for home ownership, homeowners insurance, and then the maintenance costs of my home. Okay. So that goes into our home ownership equation. And then when we think about the financing involved in home ownership, generally for most of our first-time buyers, it's going to be a 30-year fixed mortgage product. So that means my payments are fixed for the full 30-year duration. We have our average interest rate, which we're going to talk about in just a second. We have origination costs. Those are the costs that lenders are going to charge you for your financing. Now, if you're part of our Sac Day alumni, which you probably are because you're joining tonight's class, we do pass along a discount in our origination charges, which lowers those costs by $750 in your financing options. When you elect financing loan scenarios or financing options, you're going to have the option to basically bring down your interest rate by additional costs out of pocket. Those costs are called discount points. Usually one discount point is the equivalent of 1% of my loan amount. So if I finance, let's say $400,000 and I want to pay 1 point of discount point, that's usually $4,000 in additional cost. That $4,000 translates to about a 0.25% reduction in interest rate. Okay. You'll learn more about that in just a minute when we talk about interest rates. And then we have other settlement services. Those are going to be what we call as closing costs. Closing costs, when we think about those costs, they're going to be lender cost, title and escrow fees, the cost that you have with maybe the local county that you're buying in. Those would be like transfer taxes, recording costs. Generally, we recommend buyers to budget about 2 to 3% of their sales price for closing costs. Okay. And then finally, we have the other assumptions, which is going to assume that this home hopefully will go up, appreciating about 4% annually. Obviously, that can change based upon market conditions. We look at the years that we're going to be in this home, which we said 7 years initially. We have our selling cost of our home, which is right around 10% of the purchase price. And then we have state and federal taxes, and then finally the savings rate, if we were to kind of compare just saving our money in a high yield savings account. So what our calculator does is it's going to map out 7 years of renting versus 7 years of buying, right? So my opportunity of buying versus renting over 7 years is about $37,000. So that means I'm going to improve my situation by $37,000 a year in renting versus buying. Now, there is, a difference in monthly costs, right? Because my rent is now $2,000, give or take a month, but my mortgage is going to almost double. So I have to be willing to accept that trade-off for the opportunity of a $37,000 opportunity over 7 years. Now, that doesn't take into consideration the potential opportunity for refinancing down the road. So if I'm buying in today's market at 6.5 or 6.75%, and I decide to refinance 2 or 3 years from now, if that interest rate lowers on my mortgage, then my upside of, owning gets better, right? Because now I'm paying less interest costs. Now I have to, now I have an opportunity to increase or decrease, I should say, my principal of my loan, which therefore creates a widening gap of my home value versus what I owe on my house. And of course, that improves the buying scenario over renting. Now, everybody's situation is a little bit different, but we can use this budgeting tool just to kind of launch us into the thought process around owning. And does it really make sense for me? And I would encourage everyone in tonight's class, once you get the presentation material, if you have some time, run through that budgeting tool yourself. I think that would be super helpful for you. So let's kind of transition a little bit and talk about the housing market. So most of us are in the Northern California market in California. When we think about prices of homes, obviously in the Bay Area is going to look a little bit different than Sacramento or the Valley or LA or Orange County. All those markets look a little bit different. For most of tonight's class, I want to kind of spotlight Sacramento, but it doesn't look much different than most of the country, believe it or not. The median sales price is going to look different, right? But kind of the characteristics in the market don't look a lot different, because right now we're going into the spring buying months. I think we're in the first or second week of spring, right? So weather's getting a little bit nice now. And so you're seeing more buyers come out in the market. And so that's starting to maybe fuel a little bit of the housing market. Prior to the spring, we're in our winter buying months, which is generally not our busier months. However, that's starting to change quite a bit over the last year and a half. What's fueling buyer activity? Nicer weather, but interest rates starting to kind of get back to center a little bit. Not totally there, but interest rates should start to come down when we get into June. We're going to talk about more about that in a second, but there is still limited inventory in today's market, even though we're expecting inventory levels to jump by about 10% during the spring and summer. We're still seeing limited inventory. So we have buyers that are out in the market, especially in Sacramento. We're still seeing multiple offers, 10, 20, 30 offers on one home. That is pushing prices still up. And this is reflected by the kind of the chart we have on screen right now. So you have good buyer demand, limited inventory right now. So it's still pushing prices up. So median price in the greater Sacramento area is $475, so that's kind of still on the rise. Prices are just slightly up year over year, but my assessment is that as we move through spring and summer buying, we'll probably see home prices still start to rise a little bit. What will continue to probably fuel that is the interest rate environment. So there still are buyers on the sidelines right now because interest rates are not kind of really at the historical levels. You learned a little bit earlier that interest rates are around 6.5 to 6.75. We are expecting interest rates to potentially drop in June. There is indications leading that the Federal Reserve will drop rates or cut rates at the June meeting coming up just in a couple months. So that's super exciting. But the trade-off for that is lower interest rates probably mean higher prices of homes. So we'll have to kind of see what that looks like in the future here. Now, if we kind of flash back a little bit over the last, let's say 6 to 12 months, we look at where interest rates have come from. Now, in October, interest rates hit a high of 8%, which is reflected on our screen here, right? That was October 21st. Rates got basically hit a 20-year high there. And so that obviously changed the climate for home buying. Now we've seen interest rates start to slide down since that time. Thank goodness. Interest rates have kind of chopped around a little bit. The lowest we've seen interest rates in the last probably 2-3 months is right around a 6.375% level. It remains to be seen and kind of where we see interest rates going for the balance of 2024. But that Federal Reserve cut in interest rates in June should hopefully have rates kind of push into that low 6 level. And then our hope is that we'll see interest rates kind of crack through into the 5s level in 2025. But there's a lot of kind of moving parts in our interest rate world right now, and really it's going to be driven off of what's going on with the Federal Reserve rate. Now, how do we get to that rate level of where we're at today? I guess really is that the Federal Reserve has used the federal funds rate to combat inflation. And obviously we're all feeling that, right? The cost of everything's a little bit more expensive. And so as inflation cools, then we'll see more moves on interest rate reduction. And we've already seen a little bit of that already. So that's why you're going to see probably a move in June. So, that's kind of what the projections look like right now. Now, interest rates aren't the same for all buyers, and there's various characteristics that go into interest rates. So credit score makes up the interest rate, the type of product that I'm going to select, what my down payment looks like, how much I decide to finance. We talked earlier about discount points, where if I decide to pay additional costs out of pocket, that can bring down my interest rate. And finally, the term of my loan can also reduce my interest rate. Now, for most first-time buyers, you're going to elect a 30-year fixed mortgage product. At times, some buyers will move to maybe a 20-year or 15-year product, but for the most part, the 30-year fixed mortgage product is the most popular option because it allows that payment to be at the lowest available levels. What we'll do as you're on that path towards homeownership is design the right program that works best for you. So, we're going to talk a little bit about consultations later on today, which is a one-on-one session with us to design a home buying plan. But that's how we kind of figure out what the right fit is for you as a future first-time home buyer. All right, credit is probably the number one thing that goes into your selection of interest rate. It can not only influence interest rate, but the product offering, maybe even mortgage insurance that you're going to learn about in just a bit. So credit's a really important component to home ownership. So we're going to take some time to talk a little bit about credit and really how to get us into the best possible position and really to help better understand credit. One of the things that I get from clients as I meet with them throughout the day is, the difference or the concern that they see in the difference of the credit score they receive versus what we see on the mortgage side, because there's 3 different models to credit scoring. There's the credit card model, which you're going to see on your monitoring services like Credit Karma or some of the agency models like TransUnion, Experian, and Equifax. And there's also an auto model for auto shopping, and then for the mortgage model. And then, of course, as you're applying for home financing, we're going to use the mortgage model for our qualifying purposes. So I think it's helpful to kind of see what the score calculation looks like on the mortgage model. 15% is going to be how long have I had credit. So the more mature my credit file is, the better my potential credit score could be. 20% is going to be how much new credit am I trying to obtain. So those are going to be hard inquiries, but also new accounts that are open, especially in the most recent 6 to 12 months. Those are going to be most impactful to your credit score. Now, as you start that process of home buying with us, we only start with a soft credit score. And the reason why we do that, most of our first-time buyers are kind of on a longer search cycle for their home buying. So it could take them 6 to 12 months to find the right home. And so we don't want to negatively impact your score with that hard inquiry. So that's why we always start with a soft score, which does not impact your score at all. Now, there are rules in place for the hard inquiry, which basically states that if I do decide to do a hard inquiry, I have a 30-day window of time to apply with as many lenders as I want. And that's the equivalent of 1 credit inquiry hit to my score. Okay. So that's the 20% side on the new credit in use or inquiries that I have being obtained on my credit report. 30% is going to be credit utilization as it relates to revolving credit. So in that category, we're looking at credit limits versus credit balances. So let's say, for example, I have $10,000 in credit limits. I have $5,000 in credit balances. That means I'm at 50% utilization of my credit. Now, the optimal level that you want to get utilization down to is 10%. So that's the best we can get to. Now, if I'm running a little bit higher at 80 and 90%, I would encourage you to try to at least get to 50% or below on your utilization levels. Let me give our class a quick tip on how to best manage utilization. So, if you were to kind of pull out one of your credit card statements and check out the PDF file, and you're going to see 2 dates. You're going to see a billing cycle or a statement date. You're also going to see a due date, right? Now, the billing cycle date is the date at which the credit card issuer is going to send out the data to the credit agencies. We all know those are TransUnion, Experian, and Equifax, right? Now, you may be accustomed to paying off or paying down your credit card on the due date, and there's nothing wrong with that. But if you're looking to optimize your credit score, I would encourage you to change that practice a little bit. Try to pay down or pay off before the end of the billing cycle date, because what that's going to do is give you a much more improved credit score, so that when you comes to applying for a mortgage, for example, that utilization is lower, and then you have a much more improved credit score. Because getting below that 10% utilization threshold is really going to be the key to those 800 plus credit scores for you. Okay. Now, the lowest credit score is 350. Highest credit score is 850. For most loan programs, as you can see on screen, you would at least need to have a 580 credit score. And then finally, payment history is going to be the biggest kind of weighting, if you will, for the credit score. If there are late payments, they're going to be rated as 30-day lates, 60-day lates, and 90-day delinquencies. So the more severe on the late spectrum that you are, the bigger impact you're going to have to your credit score. Past challenges, short sales, collections, charge-off accounts, things that, that are delinquency in your past, most of those things will remain on your credit report for 7 years. Now, the impact to your score is going to be in the most recent 12 to 24 months. Okay. Account closure, which is our third bullet point on this screen. Account closure, what we're referring to there is if you take a revolving account and you completely close out that account, there's two big things that can happen with that. So I'd really caution you in that, is that when you close out a revolving account, it wipes away all the history you've had on that particular account with the credit bureaus, but also takes away from another available credit limit in the credit utilization equation. So just be careful of that before you start closing out accounts. In lending, we always use the middle score of all three agency scores for qualifying. So if I'm qualifying and I have my highest scores at 760, my lowest scores at 740, and let's say my lowest scores at 720, the 740 score is what we'll use for qualifying purposes, right? Now, if I'm going to apply with my partner's at 720, 700, and 680. Well, my partner score, middle score is 700. So the 700 score would be used for qualifying purposes. Okay, so it's always the lowest middle score between both borrowers. Of course, if I'm applying just my own name, then it's my lowest middle score. All right, I want to share with our audience just a quick matrix on credit. So if you've had like negative items on your credit, how long will those appear on my credit report? So for the most part, late payments, past challenges, those are going to be on your report for 7 years. Now, if you've had federal debt delinquency, that could be a little bit longer. And so you can refer back to this as kind of a matrix, if you will. Okay. All right, before we jump into student loans, I want to see if our class has any questions that, I know I've covered a lot of ground so far, but any questions so far on some of the content? Okay. All right. So if you do have questions, just drop it in the Q&A. I'll get a chance to answer those on air. We are going to carve out some time at the end of tonight's class to go over any other questions that don't get answered or asked, I should say. So we'll make sure you get those covered. Let's talk a little bit about student loans. And, with student loans, they're all in repayment right now. The federal debt is. If you've had federal debt forgiveness, congratulations, or cancellations of debt, that's fantastic. For that debt to not be factored into the equation for qualifying for your mortgage, we just need to document that through a letter, or if it's already off your credit report, then you're good to go. If you're in repayment and you're on an income-based repayment program, that's totally fine. We just got to document the income-based repayment for qualifying purposes. So in our example on screen, if you had $75,000 in student loan debt, you're at a $250 IBR payment. That's the amount that we use for qualifying purposes. Now, if you're not in repayment, so let's say I'm back in school and it's deferred, or I still have a forbearance agreement, you can still qualify for mortgage financing, but at the same time, we will have to use the aggregate total on a conventional loan of 1% of the balance as the monthly payment. For an FHA loan, we use 0.5% of the aggregate balances for qualifying purposes. Okay. So again, if you're in deferment because you're back in school or you just have a forbearance, we still have to count a minimum payment for qualifying purposes. Okay. Had a couple questions jump in the chat, so I want to just in Q&A. So let me just answer a few of those around credit, which was if my credit was frozen, should I unfreeze it before I run a soft credit score? Yeah, I would definitely unfreeze it. Usually for our soft scores, we'll do a 3-merge bureau with all 3 agencies, especially for some of the products that we offer. So yeah, so before you start applying for anything, we'd encourage you to unfreeze any of your accounts. You can generally keep those open for two days or a week, whatever the agency request is. And then, so we got a question in the chat about the recent NAR settlement. I think let's table that for later on in the discussion, so we won't open any discussions on that yet. And I'm frankly not an expert in that. My expert's going to be in financing, so we'll table that to the end of tonight's discussion. But there was a question around what were the judgments that that can affect credit scores. So judgments would be, for example, if you had a small claims judgment that was attached to your credit score or your credit file, that would negatively appear on your credit report. So that kind of judgment. So that's generally what we'll see. We don't see a lot of those on credit reports for the most part, but that's if something like, let's say you didn't pay a debt and you were taking a small claims court and they attached a judgment, that would be that kind of scenario. All right, let's talk a little bit about loan programs. And these are 5 of kind of the core programs that we kind of spotlight in our classes. And so we're going to kind of walk through the characteristics of those programs. Most of our clients, especially our first-time buyers, are going to be looking more at the conventional FHA route, but there's a variety of different programs to help support you on that path towards homeownership. So the first product is the conventional loan product, has a minimum down payment of 3%, all the way up to the conforming limit. Now, for those of us in Sacramento, which most of us are, and for our Bay Area clients as well, there are high balance limits that allow us to go up to higher loan amounts. When we go to those higher loan amounts, that minimum down payment jumps from 3% to 5%. The conforming limit for Fannie Mae and Freddie Mac loans are updated usually every year around November or December based upon cost of living. No surprise, we've seen those limits go up, gosh, as long as I've seen in the last 20 years. So, so generally those things will elevate every year. A conventional loan has a minimum credit score of 620. And so, that product will have that minimum credit score, but there's other factors that we have to look into in the conventional loan, not just credit score. They're going to look at income, assets. We're going to talk a little bit about some of the other qualifiers like debt to income ratio a little bit later. The conventional product, and we're going to do a comparison in just a bit as opposed to FHA, has a little bit less flexibility in qualifying than the FHA product. And you're going to learn about private mortgage insurance or PMI in just a minute. And that comes into play on a conventional loan. We put less than 20% down to purchase a home. For the FHA product, minimum down payment of 3.5%, minimum credit score of 580. There will be mortgage insurance on FHA products, regardless of how much we put down on that product. And I'll walk you through an exercise on that in just a little bit. Very similar loan amounts with the conventional product as we will see in the FHA product. With the FHA loan, we're going to have a little bit more flexibility for our buyers than we would with a conventional loan. And what I mean by flexibility is, for example, if I've had a late payment, let's say in the last 6 months, it might be a little bit more difficult on the conventional product versus the FHA product to qualify. So that's when we think about flexibility, FHA will be a little more lenient from that standpoint. Or let's say I've had a bankruptcy that was 3 years old, right? FHA would be okay with that, where conventional, we would have to have a 4-year seasoning requirement, okay? So we're going to talk about a comparison between conventional and FHA in our PMI segment, but I want to kind of just give you a high level of those two products. For the most part, 70% of our clients are going to utilize the conventional product, but these other products are going to be useful for our clients as well to help support them in homeownership as applicable. And speaking of that, our VA home loan for our veterans that have served is an amazing product that allows a veteran to put 0 down for their home purchase, minimum credit score of 620. There's a lot more flexibility in the VA guidelines for the veteran to allow home ownership to be much more achievable for the veteran. With VA, it is a 0 down payment option. There really is not a loan amount cap on that particular product. Generally, we'll see it go up past $1 million plus. But for most of our buyers who are buying locally in the Sacramento market, it's going to be somewhere in the $400,000 to $600,000 range. Okay. For the USDA product, that's for clients that are choosing to purchase in more rural areas. USDA has a minimum credit score of 640. maximum loan amount in the 700,000 range, but it does have a 0 down payment option. There are 2 qualifiers for the USDA product. There's maximum income by household, and there's geographical restrictions based upon where the property is located. And then finally, there's jumbo loans. Those are for our clients that are looking to purchase with a little bit more financing support beyond what Fannie Mae and Freddie Mac or the FHA product can offer. Now, with jumbo loans, minimum down payment is 10 to 15%. Credit score requirements are a little bit higher, so we have to at least get to 680 generally. And with the jumbo loan, beyond having the down payment increase, there's also a reserve requirement, which requires us to have additional assets in kind of places like 401ks, 403bs, brokerage accounts, maybe cash holdings and checking your savings accounts. Usually it's the equivalent of 12 months of my monthly mortgage payment. So if I have $7,000 in my mortgage payment, I would need an additional $84,000 in reserve assets for the jumbo loan program. All right, let's talk a little bit more about private mortgage insurance. And so we always like to do kind of a closer look at PMI, because for those of you that may have already started some of your search on Redfin or Zillow, there's some calculator functions there. But what I find in working with clients across the country is that those calculations might not necessarily be accurate. So I think it's really important for you to understand PMI, but then what goes into the calculations. So there are a variety of different ways to pay PMI. Maybe you didn't know that you obviously can pay it monthly, but you can also split MI up between monthly and some of it upfront. You can also completely buy out MI in your closing costs, which isn't really a popular option, doesn't make a lot of sense financially. There's the lender paid mortgage insurance where you get a chance to elevate your interest rate to buy out your mortgage insurance. So there's all those different options for mortgage insurance. Now, most clients will elect the monthly mortgage insurance. The reason for that is because mortgage insurance has a cancellation option on a conventional loan. When you have 2 years and if you achieve 22% equity on your home, you can potentially apply to have your mortgage insurance canceled. Now, beyond the different payment options, there's different characteristics that go into PMI. And so that's where some of the calculators on some sites cannot necessarily give you an accurate depiction of the monthly payment. So PMI factors in credit score, it factors in down payment, and the amount that you're going to finance. So those all go into the PMI calculation, right? Now, when we look at PMI on a conventional loan, I have a kind of a what if scenario at the bottom of the screen. So if I finance $450,000, my credit score is 740, and I'm putting 3% down, my PMI is going to be about $183 per month. So that might look a little bit different if you've been doing some searches on some of those other sites. Again, we're taking in consideration those characteristics that will make up PMI, like the credit score, down payment, and amount financed. Now, if I can elevate my credit score to 800, now that PMI decreases. Or if I put more money down or I finance less, that can also drop the cost of my mortgage insurance. Before we talk about FHA, I just take a quick question, which is, can life insurance substitute for PMI, and can it be cheaper? So life insurance is completely different spectrum. That's going to be obviously cover something was to happen to you. PMI, and I probably should give you a little bit more background. PMI is insurance that's not covering you like credit insurance. So sometimes you can take out credit life insurance or credit disability insurance. That's when you have those in conjunction with a financing tool. Like, for example, let's say you pass away, right? And the credit life insurance would cover potentially the balance or a portion of the loan balance. PMI is private mortgage insurance. It basically covers the lender against default by the borrower. So if I defaulted on my loan, a PMI company would come in and protect the investment of the lender. Okay, that's a really good question. I appreciate the audience member for bringing that, because PMI, there's, can't be assumed that we understand what the function is of PMI. Now on FHA, there's PMI too. And we talked a little bit about it earlier. FHA PMI has 2 functions of PMI. You have to pay for it upfront, which gets added into your total amount finance, and you also pay for it on a monthly basis. PMI on FHA cannot be canceled. It only can be canceled by refinancing into a different product like a conventional product. So FHA is generally a temporary solution for our buyers. So it helps us to get into home ownership, but I really wouldn't want to keep that product too long, because we want to, as we get appreciation in our home, hopefully we're looking to transition into more of a conventional product with a cheaper expense setup for you. However, when we look at the PMI option, if we take the same kind of side-by-side comparison, finance 450. Now with the FHA product, we do have to add an upfront mortgage insurance. So that adds in 78.75 into our total amount finance. So that pushes that up to like 457, 875. The monthly mortgage insurance is just over $200 a month. So it is going to be a little bit more expensive on the FHA side. So there is a trade-off, right? So, when we're looking at this side-by-side comparison, we may say, well, why would I want to go with FHA? Because, at the end of the day, it's going to be more expensive than conventional. And that is absolutely true. But as we talked a little bit earlier in our program segment, there's a little bit more flexibility in the FHA product than we might see in the conventional product. So while it might be cheaper for conventional, because of our qualifying, we might have to go with the FHA path, maybe because we have past credit challenges, or, it's just an overall better fit for us. So, and those are things that we'll talk through as part of a consultation with you. And as we design a home buying plan for you, we'll figure out what the best product fit is for you. Another question in the chat was, do evictions affect your credit score? So they might not affect your credit score, but if that landlord has taken the next steps and maybe sued for, I don't know, maybe let's say there was past due rent or something like that, that could impact you as well. Kind of in that same, I'm going to kind of dovetail in off of that a little bit, just to talk a little bit about alternative credit. And this kind of goes back a few slides, but I just want to kind of highlight for you, if you're just starting credit, which I think it's helpful to understand this, there are ways to put alternative credit on your credit report. Experian, and I'm not promoting Experian, but Experian offers an Experian Boost program, which if you don't really have established credit, can allow you to report your rental history, utilities like PG&E, SMUD, to your credit report to help establish credit history. The reason why I say that is because you got to make sure, obviously, you pay those bills on time, because the trade-off is if you don't pay them on time, you'll have a negative reporting to your credit. So, I think I just want to share that with you, because that's a great way to build credit, but there's also, the importance of paying on time with that. All right, great questions from the group tonight. Let's talk a little bit about qualifying income. I want to share with you a little bit more about employment or income sources that can be used for qualifying for your mortgage. And let's talk really quickly about some of the documentation that you'll need to gather as you take these next steps towards homeownership. So generally, you'll need to bring together the last 2 years of taxes, 2 years of W-2s, last 30 to 60 days of pay stubs, and then bank statements for asset proof. That's generally what we'll need in documentation preparation for deciding on what homeownership options work best for you. Now, in looking at income sources, a variety of different income sources can be used. There is, requirements that we have to show at least 2 years of work history and or education to qualify for financing. So let me give you an example. So let's say I graduated from Sac State in the fall and I just started a new job first of the year, right? If I went to Sac State for 4 years, I just started my job, I meet the 2-year requirement because I've shown that I have education that's in my kind of field of work now, right? So that would meet the 2-year requirement. So a lot of misconceptions that we see from clients is that, maybe some people have been told that I have to have 2 years on my job, which just isn't the case. We just have to map out a 2-year work history. So even if I am currently working on my job right now and I've been there for 6 months and I have a new job opportunity to start next month, if I have an accepted offer letter from that new job, then I can use that for qualifying purposes. Okay. Now, where it gets a little trickier, though, from the 2-year requirement is if I, let's say, have multiple sources of income, like let's say I work in the healthcare industry and I work at 2 facilities. In that case, I do have to show that I've been on both jobs 2 years in order to use both sources of income for qualifying purposes. Now, if I'm self-employed, so that means I'm like a 1099 independent contractor, I have my own business, I do have to show that I've been in business for at least 2 years in order to qualify for a mortgage. Now, for my application, if I decide to apply today and I only put myself on the application, only my source of income can be counted in my application. So even if I have my partner that's contributing to the household income, unless my partner is on the application, that income cannot be counted towards qualifying purposes. Okay. Another thing that comes up is if I have additional employment. So let's say I have a 40-hour work week job, but I also work for Uber or drive for Uber on the weekends, right? So if I want to include my Uber income, I have to show that I do both jobs simultaneously for 2 years in order to count both sources of income. All right. Any questions around income or documentation needed for the home buying process? All right. Okay, let's stay with income for just a little bit longer. I want to talk to you a little bit about a really simple calculation called debt to income ratio. And it basically looks at your gross monthly income versus your outgoing expenses. And it's a really simple calculation that's going to factor in the expenses like your new principal and interest and the taxes and insurance for your new mortgage. So, principal, interest, the property taxes, and insurance for your new home. If I put less than 20% down, PMI, right? If I buy a condo, townhouse, I got to factor in HOA expenses. So I put that into my monthly debt. And then my credit cards, personal loans, student loans, car loans, those go in under my monthly debts. So when I look at the equation, I have my total monthly debts, including my new house, versus my monthly income. That gives us a percentage called debt to income ratio. So you can see on screen, in this particular client situation, they have $3,000 in debts. They have $8,500 in monthly income. So I come up with a 35.29% debt to income ratio. So the highest we can be is usually 45 to even 50% on exception. The question I get from first-time buyers is, where should my debt to income ratio be? The tolerance level varies for every client, but in working with hundreds and thousands of first-time buyers, it usually is around 33 to 36% debt to income ratio. It's kind of the comfort zone, so to speak. But my most important kind of question for buyers is, what's comfortable for you? What's affordable? Because everybody has a varying tolerance level for affordability. And that kind of leads me to our two important goals around home ownership. And that is, we want to create affordable and sustainable home ownership for you on this path towards home ownership, because there's no sense of qualifying for something that's not going to be sustainable for us over time, right? Debt to income ratio gives us a calculation for qualifying, not necessarily indicating affordability. All right, let's talk a little bit about our last component in building a home buying plan, and that's just savings for assets. Now, we talked a little bit about earlier in qualifying for home buying, we do need to save up for our down payment, which you learned earlier, that's a minimum of 3%. And then closing costs. And closing costs can range from anywhere from 2 to 3% of your sales price as an estimate, right? So those are the things we want to kind of think about from a savings perspective. You know, we put savings plans together for clients to help them on the path towards home ownership, where we're kind of just figuring out, like, how much money do we need to allocate towards this home purchase? And that level does vary based upon the price of my home. So if I'm buying a $400,000 house, I may need $20,000, versus if I'm buying $1 million place, I might need $40,000, $50,000, or $1,000 more than that, right? And we're going to talk about first-time buyer programs in just a second, but I think it's important to understand savings goals on that path towards home ownership, but we can certainly talk about later on in tonight's class. These are some of the documents that we generally need in qualifying assets. Now, cash cannot be used in buying a home because everything has to be paper trailed for home ownership. Now, you can use gift funds, and that's where a family member has contributed funds towards your home purchase. Gift funds do not require any type of seasoning requirement. So you could have a family member that transfers you funds that we do have to paper trail the funds, but those don't have to be seasoned like other assets of our own that generally have to be seasoned for 60 days. So you could also at times leverage 401ks, 403bs, IRAs. Those are all allowed. I would encourage you to talk to your financial or tax advisor before you get into those assets, because that, you know, could have some tax implications or investment, you know, strategy impact for you. As we're figuring out home ownership, you know, it is a challenge to save. I totally understand that. I work with buyers in all kinds of different financial situations. And there's usually two challenges to home ownership. It could be credit, because maybe we're just a little bit overextended or we've had some maybe past challenges. More often than not, it's savings. And a lot of our students that attend our classes are maybe planning for 2 or 3 years out for home ownership. But what they find in joining some of our classes is there's some really great resources that are available to you. And since most of our classes in California, I thought it'd be helpful to talk a little bit about CalHFA, which is the California Housing Finance Agency. Some of you might even heard about CalHFA already because they're spotlighted a lot right now, especially with the Dream for All Shared Appreciation Program, which I'll share with you in just a bit. But CalHFA provides resources to low and moderate income households in homeownership. And so we happen to be the #1 CalHFA lender for the products that are offered. So I'm really passionate about it. We believe in this product to help serve our communities in homeownership. So I thought I would share with you a little bit about some of the products that are available. First of all, there's the MyHome Assistance Program that provides up to 3% of your sales price in assistance. So you learned a little bit earlier about the conventional product. It would fill the void to cover your minimum down payment for a conventional loan. It also covers 3.5% if you elect to have an FHA loan. And what it is, it's a simple interest rate loan at 1% interest, and you don't have to pay back the assistance until you either sell your home or if you decide to refinance in the future. There are no monthly payments on that assistance. It is not paid back again until you sell or refinance. You can also add in combination with that the zero interest program called ZIP. ZIP is not, as useful right now because the interest rate environment's a bit high still. But it ultimately can provide up to 2 to 3% of your loan amount in zero interest assistance. You have to first participate in MyHome Assistance. And then if you need additional resources, ZIP can be added on. And then the California Dream for All Shared Appreciation, it has a lot of the spotlight right now. It's on a lot of the media outlets right now. You've probably seen some of our YouTube videos on the program right now. The program provides up to 20% of your sales price in assistance or $150,000 for first-generational home buyers and residents of California. It's a popular product. It does come with some requirements that we'll kind of share with you in just a bit. It is a lottery-based program. And so what's happening right now, we are pre-approving clients for their eligibility for the program. The registration runs from April 3rd to April 29th. And then early to mid-May, recipients of the program will be notified as winners of the lottery, and then they'll have 90 days to go out and find a home. On our YouTube channel, which you'll learn more about that later on tonight's class, we have a full hour-long presentation, which is a Q&A session on Dream for All. We're not going to have a lot of time to dive deep into that tonight in class, but I would encourage you to check out that channel for that video and some helpful resources on Dream for All. There still is time to apply for Dream for All because it is a registration window open for 26 days beginning tomorrow. For the MyHome Assistance Program, I wanted to show you a quick example on how that program can support you. So, if you bought a $450,000 house, knowing the minimum down payment is 3%, that's where MyHome can help supplement that minimum down payment for you of $13,500. So like in a traditional sense, if you purchase using a conventional loan, you probably would need $22,000 to upwards of $27,000. But if you can supplement with the MyHome Assistance Program, now that brings that out-of-pocket total to maybe $12,000 to $15,000. And of course, if the ZIP assistance did work, could lower that to maybe $2,000 to $5,000 out of pocket to purchase a home. So that's kind of where the MyHome and ZIP Assistance Program fits in. Now, there are income limits to the CalHFA programs. You do have to be a first-time buyer. Specific to Dream for All, you have to be first generation and a first-time buyer. On the left, you can see the MyHome Assistance Program income limits. We kind of gave you a spotlight of Northern California counties that would probably be most relevant for you. I know we have a few guests joining us from San Jose. Those income limits are up to $300,000 for MyHome and $292,000 for the Dream for All program. Dream for All does require you to be a first generational buyer. So let me kind of explain what that means. If you're interested in Dream for All, first generation means that one of you, so one of the buyers, let's say if I'm applying with my partner, so one of us would have to be first generation, meaning that I haven't owned a home in the last 7 years and my parents are not currently owners in the US. So one of the applicants would have to meet that qualification. So that's a really important component. This is phase 2 of Dream for All. It's different than phase 1 in that you receive up to $150,000 in assistance or 20% of your sales price, whichever is less. You can contribute up to 5% of your sales price on top of that allotted shared appreciation loan. Okay. Again, check out that YouTube channel for the last class we taught on that. Here's the minimum eligibility requirements for CalHFA. So minimum credit score is 640 for the FHA version of the product, 680 for the conventional product. There's minimum debt to income ratio requirements. One of the cool things about CalHFA is we don't look at total household income. We only look at applicant incomes. And why that's important is because if I apply in just my name, my income is the only income considered for the application. Now, that's the only income included for qualifying, so it may diminish my buying power, but that's how we look at the income for qualifying for this. Now, a first-time buyer is someone that hasn't owned in the last 3 years for a CalHFA product. And this product's eligible for any type of one-unit property, single-family homes, new construction, condos, townhomes. Even manufactured homes are eligible, but it does have to be on land that is owned. You can't like purchase bare land and then construct with these type of products. It has to be more existing type structures. You can buy new homes, but it can't be like a ground up build. All right. I got through CalHFA pretty quick because I wanted to get you guys through the process of buying. But any questions about any of the CalHFA products? I know since we're primarily a California audience, any questions I can answer for the group, and we will carve out some time later on for Q&A too if you don't have the question ready right now. So question in the Q&A was, is there an age cap on the Dream for All program? There is no age cap. So no age cap on any loan program. So that's illegal. Cannot have an age cap on products. There is no minimum income either on any of the products, but there is the maximum incomes, which you saw earlier. All right. Okay, let's talk about the steps of buying a home. We call this our 6 steps of home buying. I think it's important to understand and use this kind of visual tool to see, like, if I really think I want to be on this path towards homeownership and I really kind of like what I heard in tonight's class, where do I need to go from here? So it does start with a consultation, and that's a 30-minute session with me for a one-on-one to just review your options for you and kind of put together a strategic plan for home buying. Now, once we're done with that, that then allows us to deliver a pre-approval for you. And a pre-approval allows you to begin shopping for homes, but then that pre-approval can be used to present offers to a seller. Pre-approvals are good for 60 days. And because as first-time buyers, the buying process might take a little bit longer because you're just trying to find the right property that fits for you. We can always easily recertify your pre-approval at any time. The house hunting phase can generally take the longest, but the house hunting usually starts with connecting with a realtor in the community that you're looking to purchase in. We do have preferred realtors that we work with that we can get you connected with. A realtor will help support you in your negotiations of your price, inspections on your home, of course, finding the right price or right price of home, but the more importantly, the right community that fits kind of the characteristics that you're looking for in a neighborhood. And you know, I think somebody in the chat mentioned a little bit about the NAR settlement, which changes kind of how buyers are represented by real estate agents. We're not going to have time to go into that settlement. It kind of just changes, you know, how agreements are set up with sellers and buyers. We'd encourage you, and we can kind of send out some follow-up links if you want on the settlement for you to check that out. But you know, we still would encourage you to connect with a realtor, because realtors should be an expert in helping you find the right home that works within your budget after communicating or working with us as a lender. Now, let's kind of fast forward a little bit. Let's say you get a chance to find the home that really fits for you, and you do submit an offer and the offer gets accepted. That brings us to step 3, and that's when we enter escrow. And now you have a ratified contract with a seller. That process from acceptance of offer to step 6, which you actually get the keys to your house, that takes about 30 days. Okay. Now there are steps that go into place once you have an accepted offer. First of all, you're going to get a call from me congratulating you and say, hey, great job. You have an accepted offer. Give you a little bit more of a glimpse into what to expect ahead, some of the team members that'll be involved in the process, and to schedule you for your follow-up video consultation. That's where we get a chance to kind of review the updated items for your financing, what the current interest rates look like, what your out-of-pocket expense looks like, what the monthly payment looks like, because that's obviously super important. Within 2 to 3 days of the accepted offer, you'll be expected to make an earnest money deposit for your home. Usually that's the equivalent of 1 to 2% of your sales price. And generally you'll have inspections then start to be ordered, like the home inspection, you'll have an appraisal ordered through your lender, which would be us. And then within 72 hours of the accepted offer, you have disclosures delivered to you that show kind of the highlight of everything we've reviewed during your follow-up consultation. This is kind of a slide that just shows you what goes into an earnest money deposit. Again, that's 1 to 2% of your sales price. It does vary based upon where you're buying in California. If you're in the Bay Area, sometimes it'll be 2 to 3%. Now, those funds do go towards your total out-of-pocket expense. And the earnest money is generally protected by what we call the contingency period. The contingency is usually in the first 14 to 17 days of the contract. It can be shorter depending on how competitive you want to make your offer, but it allows you to do your homework as a buyer to get the house appraised, to ensure the house is worth what you're paying for it, get the house inspected, and then finally get your loan approved. So you have protection as a buyer to make sure this is really the right property fit for you. Now, moving on down the process, step 4 would be the administrative tasks of your loan, processing and underwriting of your loan. Usually by that time, your rate is locked in on that particular product. We're going to get everything verified so we can submit everything to our underwriter. And an underwriter will actually review all your income, assets, credit to make sure everything aligns with the product type that we've selected in our review for you. That underwriter will issue the approval at step 5. It also brings us to the end of your contingency period. So if you feel comfortable with all the work you've done on the inspections, the appraisal checks out, your loan gets approved, then you can sign off on the removal of your contingency with your realtor. That gives indication to the seller that you're ready to move to the final closing stages of the process, because we're about 3/4 of the way there. Now, at that time, we're going to deliver to you a final closing disclosure. It gives you a 3-day cooling off period before you get to the very final milestone of the process, which is called closing your loan. And that closing disclosure gives you a protection to make sure everything aligns with previous disclosures that you received. That's an electronic disclosure. By the way, everything you receive in the home buying process is all e-signature until we get to step 6, because at step 6, we do have to sign final loan documents still in person with the public notary. It's still a little bit more of an old school process at step 6, because you do have to meet with the notary, which is about an hour-long process. On that day, you'll be wiring in final funds for the escrow. And then once everything is completed with signatures, funds are wired in, then we wire in funds for the home financing and any assistance programs that you're going to elect for your home purchase. And then what goes from there is that documents get recorded with the county recorder's office. So if you're in Sacramento County, which our recorder's office is just a block away from us here in downtown, the documents get recorded, which is a grant deed to transfer ownership. And then the deed of trust, which is it's basically the loan agreement that you have on your property. Once those things get confirmed, then you become the official owner of the property. I get a chance to make one of those calls at least 2 or 3 times a day. It's my best part of my day, because now you've gotten to the finish line. You've got a chance to become a homeowner. And it's truly something to celebrate, because it's a massive accomplishment. It's going to be one of the biggest financial investments that we decide to make in our upcoming financial futures. And again, you guys are taking time out of your busy schedules to spend an hour with me on a Wednesday night, when I'm sure, or Tuesday night, I'm sorry, when you probably have better things to do. So those are investments you're making to really prepare yourself for homeownership. But it's a huge accomplishment when we get to the end. Now, if you're thinking about moving forward after tonight's session and want to learn a little bit more about what home buying can be for you, there's a couple different paths you can go down. One is, if you just have some questions, you want to get connected with us, you can schedule an introductory call where you get a chance to meet with one of our team members to answer a few questions about maybe your particular scenario or follow-up questions around programs. If you want to design a home buying plan with us, you'll meet with me one-on-one for a 30-minute session. It entails you completing an online application. We do a soft credit check, but that doesn't impact your score. Then you upload proof of income and assets, and then use our online scheduling tool to schedule a consultation with us. Now, right now, because we're fielding a lot of inquiries for the Dream for All program, our scheduling system is about a week out right now, but we'll make sure that you're well taken care of on any type of programs, and make sure we have that home buying plan in place for you. So whether it's a goal for 2025, or maybe or 2024, you're planning out to 2026, we want to just help be a support and resource for you on the path towards home ownership. Here's kind of what a consultation looks like for you, so to better understand the framework of a consultation, kind of including, where do I want to purchase? What's my budget look like? Can I improve credit? What do I think I need to be targeting as my down payment? What programs best fit for me? All those things we'll review during a consultation. We have some great tools and resources that are available to you on this journey. One of those includes our mobile app. You can start the application process right via mobile. You can follow the progress of your loan. You can upload documents and then use the calculator all in mobile. Of course, it's available via Android or Apple in the App Store. Okay. And you're joining tonight's class because of our amazing partnership with Sac State Athletics and Alumni Stingers Up. And we do have other partnerships all across the country. So if you have friends, family, maybe some coworkers that would really benefit from attending one of our classes, they're generally free to all of our, communities that we serve across the country. Here's all my contact information. So after tonight's class, if you do have some follow-up questions, want to get connected with us, please feel free to reach out to me. I try to be available as much as possible for messages or calls. And we would encourage you, to follow us on some of our social channels or just check out what we're putting on social, especially on Instagram. We're putting a lot of, I think, good resources for first-time buyers. And our YouTube channel, which I kind of mentioned earlier, highlights a lot of our videos, including your class that you're getting recorded right now, will be up on our YouTube channel. Our social is JMeda Mortgage. You can find that really easily. And we love what our local communities say about us on our Google reviews. We really try to work hard in the client experience. So we encourage you to check those out as well. So we're at the end of tonight's class. I'm right at the top of the hour. We made it. But I do want to carve out some time for some questions. I'll be here as late as you guys need me to answer any of those questions. So if you do have questions on tonight's class, go ahead and just drop those in the Q&A and we'll get those answered for our group. So go ahead and start with those and we'll answer any questions we have for our remaining audience. Any questions? Right. I know we try to grab most of them in as they came in through the Q&A. All right. I think we're okay. So I just want to, thank you again for attending tonight's Sac State Alumni Workshop. It's a pleasure to be able to present this content to you. Reminder, we'll have 3 more classes just like this for the remainder of 2024. So encourage your friends, family, coworkers, come check this out. We would love to be able to help support them and give them some more resources in home ownership. I wish you all have a wonderful evening. Enjoy the rest of your week, and we'll talk to you soon. Good night.